Welcome back to another episode of Harmonious at Lunch, the show that fuels your business success. I'm Brandon Gano, your host and guide through the world of harmonious business growth. Today, we're unlocking powerful strategies with industry experts to help your business thrive. If you're a business owner, entrepreneur, or executive, you are in the right place. Join me and our incredible guests today on the journey to clarity, growth, and success. It is time to revolutionize your approach to business. Let's dive in with another episode of Harmonious at Lunch. Welcome back in. This is more bite-sized business advice. We're talking about everybody's favorite topic today. We're talking about money. All right, maybe it's not your favorite topic. I know it's very polarizing. And because of the nature of the internet today, I think I have to say this is for entertainment purposes only. But anyway, outside of that, we're going to talk about your money. Time to rethink your investment strategy. And this is a passion for mine for all the small business owners and entrepreneurs out there, because we tend to get so focused on the now, focused on growing our businesses, that we forget that there's going to be a life after that business. And a lot of times when I talk to our clients, we're very unprepared for that future of what that may be. So let's rethink the way that looks. I have an amazing guest here with me today, and we're going to dissect this and figure out a better way to do it. So before we go any further, welcome Steve Selengut to the show. Thanks for being here.
Thank you, Brandon. Good to be here. And I'm one of those people that's out there beyond that end of the first entrepreneurial effort, the guy who's no longer in that business that he was in for 40 years and has started a new one. So, how I got here might be of interest to your listeners.
Yeah, I'm curious. You were telling me before we started recording that you were able to leave your first job because your investments were making you more money passively than your job was. So I want to hear that story, because you actually said at a very young age too, which is even more compelling. So I want to hear that story, because I don't think a lot of listeners can relate to that.
Okay. Well, it wasn't really passive, but
okay, fair enough.
Okay,
I
but
want to hear it though.
In investing, a lot of people think that passive can do it, and there are some types of investments that do produce adequate passive income. But I would bet that most of them, if you looked at them as you would merchandise on the shelves of a store that you were running, you'd see them as something more. You'd see them as a product. As well as a producer of income. They're a product that you can sell for a profit. And that's how I approached investing. When I first started, and I was very fortunate, I won't even get into it, but let's say I did not come from the wrong side of the tracks at all. And when I got out of college, I had some substance that I had to invest. And I immediately got into the stock market. I only would deal, for some reason, probably my parents, I wouldn't get interested in any type of security that didn't pay me money for the use of my money, because you're really an owner of these companies. They don't treat you much like an owner. You don't get the big bucks like their officers do, but some of them are kind enough, or I should say respectful enough, to pay you some dividends. So I only use dividend stocks. And then I discovered the world of the market cycle, that looking back over time, if you look back at a company like IBM, for example, one of the first technology stocks ever, and you looked at the volatility of the price of that, you'd see that there are probably thousands of opportunities where you could have bought it at a lower price and sold it at a higher price and made, 5, 10, even 15% in the process, and still get back in again at some future date and do it again. I had a large portfolio of stocks. I had maybe 40 or more different stocks in the portfolio that I'll use the word inherited, although it wasn't actually somebody dying to give it to me. It was more of an endowment than anything else. So what I did was I started to say to myself, I've got a lot of money here. I'm not going to do anything risky to lose it. But what I'm going to try to do is I'm going to try to make it produce enough money for me so that I can stop commuting to New York and getting paid this, what I considered a pretty meager salary I was getting working for the company I was. The only good thing about that company was I was working in a pension investment department, and I used their um, um, investment program as a defined contribution investment program with mostly individual stocks, and I used that to create the portfolio that I was building as I sold my old stocks and bought new ones or added to the portfolio. I felt that I needed to be very well diversified. I needed income, and I took profits. And like I said earlier when you and I were discussing it, by the time I was 34 in 1979, long time ago, I know, I was making 5 times my salary with the dividends, the interest from the income side of my portfolio, and the profits I was taking. And I decided at that point that I wasn't going to commute anymore, and that I'd start my own business managing money for other people. And I did that from 1979 till 2023 when I sold the business. At that time, I was managing about 110 million for 150 people or more. So
Wow.
that's the story, and it wouldn't have happened if I didn't have that income focus. And I brought that focus to hundreds of people over the years, where I would take their portfolios and show them how I was going to make it instead of grow in market value sometimes and then drop in market value at others, and not produce any income, to one that, regardless of which way the market was going, it would still be producing income. And not only that, that we'd be able to grow that income every quarter, every year.
That's really interesting because I think when a lot of people hear the stock market, a number of things come up. It's either, it's confusing. They feel like they just have to hand their money over to a financial advisor and hope it grows, kind of thing. But you had a very specific strategy that obviously worked for yourself and a number of other clients too over the years. And I'm curious if we could maybe break that down a little bit, or give us some pointers if we wanted to go see if this is something that we could do on our own. Where do you start with this type of strategy?
I think you start with defining there are four different ways to minimize the risk. And I think you have to go into investing, particularly when you're young. You can't just say, "Oh, good, I got my IRA contribution for the year. I'm going to throw it all at this particular stock and hope it makes me rich." Because chances are you'll have the same size IRA for the first 5 or 6 years if you do that. You're not going to succeed. You may get lucky, but more than likely you won't. So instead, what you have to do is develop there are four things you have to do to minimize the risk and keep yourself focused where you need to be when you're running an investment portfolio. And very simply, um, you have to make sure you have to come up with ways to judge the quality of the investment in the first place. Uh, how long has the company been in business? Does it pay a dividend? How is it fit in the competitive environment it's in, et cetera? Um, that's the first one. The next one is diversify. I can't put too much money in one thing. I got to spread it out. I never, for my clients, no matter how large or small the account was, I tried never to have as much as 5% in any one security. Most of them had less. The larger the client, the less they had in any one security, the larger the portfolio. The third thing was, everything you put your money in, you must make sure it pays you a dividend or interest. A lot of attractive companies don't pay any dividends. Eventually, you're going to need this income, and you can reinvest this income. Um, and the final thing is to take your profits when you have them. I mean, you've witnessed at least two market crashes. You had the mini crash of
Yep.
2000, 2020.
Three, technically.
You've had the Great Recession in 2008 or 9, and you were probably around for the dot-com thing, right?
Too young, but yes, I was around for that one. Yeah, so
Yeah.
3.
The one before that was called they called it the crash of '87, and which I really feel is just a computer loop, because that's when they really first started having these robotic trading systems where
Mm.
they would find a price, and then they would, if it went to this price, they'd sell, but it kept spiraling down and spiraling down and spiraling. That's my theory of how that one happened, because I was buying all that time. So those are the things. You have to take your profits when the market is up. You have to take reasonable profits. You have to set targets, just like you would set prices in a department store for the goods on the shelves. And you treat them the same way. My department store contains every possible product and service that happens anywhere globally. I own that many different securities. And that's how I did it for my clients. I couldn't do it quite as completely for everyone, but as much as I could. If something was going up, I wanted them to be in a position to take advantage of it, and I would take their profits for them, and then I would reinvest it either in a similar industry or a different one, whatever. But I was always I developed universes of securities that met my quality requirements. I made sure of the income they produced and that everything was diversified and so on. And I set these strict targets for profit taking. And the results were that the income generated would grow every quarter and every year. And not only that, that the capital investment, the amount of money that's working in the portfolio would grow and grow and grow, even though the market value would vary all the time. I mean,
Mhm.
I made market value or market volatility my very best friend.
Yeah, I mean, well, if you're going to leverage it, if you're going to take profits when it's up and then reinvest when it goes down, it's very
Right.
easy to see how that could quickly compound into a very lucrative portfolio. So I'm curious, because this is really interesting. The taking profits makes complete sense. The finding income producing stocks, dividend paying stocks, you can probably Google that and get a list of
Sure.
thousands of them. So that's relatively easy. Um, but what I like that you said is, if we break this down for the listener, let's say you're not in the stock market at all. You said 5%. So at the very least, whatever number of stocks that you're going to invest in, have a minimum of 20 different
20
stocks.
positions.
That'll get you to your 5%.
Right.
The first point, though, the grading system. I'm curious what qualifications or what sort of metrics you look for to qualify a stock as a good one versus one that you maybe wouldn't invest in right now.
There used to be, up until maybe 10 or 15 years ago, the Standard and Poor's Corporation used to have a monthly guide that they send out that you could subscribe to, and it would list all the stocks, and they had B plus or better was what they called investment grade. And in order to be a B plus company, you had to pay a dividend. So it made my life a little easier. So you had B plus, A minus, A, and A plus. So I used that methodology. When that book went away, it became more difficult, and you pretty much had to rely on comparisons. How did this company do compared with other companies of the same type, price wise, which wasn't a metric that I was interested in. So I moved away, not from the stock market, but from the ownership of individual stocks. And instead, and unlike many people in the business, I chose a type of vehicle that was a trust vehicle, and it's called closed end funds. And not many people have heard of them, and not many financial professionals use them for various reasons. But these are the uh, oldest type of fund available in the marketplace. ETFs have only been around, you know, 20, 25 years. Mutual funds have been around since the late 1800s. Closed-end funds have been around since the mid 1800s. They're older, and the brilliance of the trust vehicle for the consumer, for the investor, is that the focus is income production, and they're required to to give 95% of the income they produce back to the shareholders. Now, can you imagine if Amazon gave us 95% of its earnings? I mean, there'd be an awful lot of wealthy people out there as
They'd
shareholders.
also be out of business.
Right. They wouldn't have been able to grow their business.
Yeah.
So with closed-end funds, we're not looking for this fund to grow its size, its price. Okay. We're looking for it to produce income, and that's what it's focused on. So it's perfect for the old people like me. It's purpose for the young people like you to have a lot of money to spend when you become an old person like me. So that's the type of security I use. So I don't have to worry nearly as much about the type of stocks that these managers choose. When I have a portfolio of 20 or 40 or 200 different closed-end funds, and there are only about 450 of them that exist. And my universe that I have is around 220 of them. So I've gleaned these 200 positions by testing them for types of quality checks and diversification potential and income and volatility, because that's what you need for profit taking, particularly if you want to do the profit taking and continue to do the profit taking with the same group of securities. It's like, again, the department store illustration. I mean, they sell a pair of pants. They don't say, okay, I'm done with pants. They go out and get different pants and they put it back on their shelves and they sell them again. It's the same thing with closed-end funds. I'll sell it. I'll buy it back again. Who knows when? And I'll do it again and again and again and again. And I just, from my experience with them, the distributions are stable, consistent for years and years. And on a really good market year, they pay, because they take in profits, they pay extra dividends at the end of the year because they have to.
That's interesting. Yeah, I've never heard of that product. How does that compare to the dividend you'd get from, let's say, Coca-Cola? I mean, are they comparable dividends, just a little bit more predictable?
No, they're much more. They're higher, and the reason they're higher is for several reasons. They have it's a large portfolio, and there's the trading. There's also they do things like safe options, things like covered calls. They'll do that, and that becomes income of theirs. They'll issue preferred stocks. The ownership company. Oh, and the people that the companies that produce closed-end funds are BlackRock is one of the biggest investment companies in the world, and it's one of the biggest producers of closed-end funds, or biggest owners or developers of closed-end funds. Nuveen, Eaton Vance, Crumman Foster, not Crumman Foster, Crumman somebody, and many. There's 45, 50 different major financial institutions that produce closed-end funds, but they're not of interest. And this is the important thing you should know. It's not because they're bad that they're not used by most professional advisors. Professional advisors and advisory companies, and this is what I was up until last year, are paid on the market value of the securities under their management. It's called AUM, amount under management, or assets under management. That's how they get paid. They do not get paid by providing their clients with an 8% or 9% stream of income that allows them to travel the world and live their lives like they want to. Okay. Closed-end funds do, but normal investment management programs produce maybe 2 or 3% of income. And you can check that out with your own portfolio when you get a chance. Whereas these portfolios will not grow in market value unless interest rates are very low at the same time that stock market is very high. Okay, because they're called interest rate sensitive securities. In the old days in the stock market, you knew that your utility stocks were always going to go down when interest rates went up because they paid such a large dividend. it's even more true in closed-end funds because these guys are paying right now. They're paying over 9%,
Wow.
and or more, and so interest rate changes. Today they're doing good because somebody must have said, or yesterday they were doing real well because somebody must have said the news is so good about inflation that the Fed may just lower interest rates, and that makes all interest rate sensitive securities go up.
Yeah.
Today, I think somebody might have said, maybe not so fast, guys. They may not do so. And you can tell just by the price movements what the talk is on Wall Street.
Yeah. No, that's super interesting. This is a fascinating conversation. Like I said, I've never heard about this product, and really cool to be, again, planning for the future, but also making money in the short term too. I think that's an amazing thing to have, that second stream of income. Don't go just head down on your business. Have other investment streams, income streams.
Right.
That's the whole point of growing your wealth. So what I did here, I put your website on the screen. If you want to learn more about what we talked about in this conversation about Steve, theincomecoach.net. It's also in the show notes down below wherever you're watching or listening. And Steve, you also have a book,
I
which I
do.
will include the link down in the show notes below. But give me the quick sales pitch on the book,
Quick
because I think
sales
this is
pitch
awesome.
on retirement money secrets. Um, Many of the things we just talked about in that very brief thing, it was an outline of what's in here. It tells you how to go about changing your mindset from a focus on just the market value of your portfolio to a focus that is on the income that that portfolio produces, and how to get from here to there to get to the point like I did where you can say, hey, any day now I'm going to be making enough money on my investments that I'll be able to sell my business and move on, or leave my business and do my own thing. All of those options. If you have enough income, all of the options are there for you and you can do whatever you want. If you don't have the income, you're tied to an employer or tied to your own desk in your business. You gotta create that income.
I wholeheartedly agree with that. This has been fantastic. So, Steve, first of all, I have to thank you for coming here. This has been amazing. But I have one last question, and I'd like you to provide the question. So, we believe here at What If that powerful questions get powerful answers. And as you can see behind me, there's a giant obnoxious question mark because we really believe this. But in terms of this conversation, how can a business owner, entrepreneur, how can they start to think about their future, and what they should invest in and what their future could look like with this maybe potentially large income stream that they don't necessarily have to work for? Well, they definitely don't have to work for, but what is a question you would want to leave the listener with so that they can get themselves started on this path?
Uh, take a look at your existing investment portfolio. Examine it and say, hey, you've worked hard, you've got your own business going, you've got six figures invested with a financial planner or on your own. How much income is it producing? If it's not producing right now over 6 or 7%, then you can be doing better, much better. Um, most of the people, I have Facebook groups that do this and that have read my book and have followed me and so forth. And I would bet if you got on that group and you asked the question, how much are you guys making on your portfolios right now in spendable income? They'd be telling you that it would be close to 10%. And that's just because prices are down now because interest rates just shot up 5% in the last year and a half. But it's reality. That's what
Yeah,
they're doing.
that's
So
awesome. Yeah, I love that the shift in mindset too that you mentioned. That's powerful. It's a great question too. So, Steve, thank you so much for being here. This is an awesome episode.
okay, thanks for having me on. Appreciate it.
For those of you watching, listening, wherever you are, I hope you got a ton out of this. I know I did. It definitely expanded my mind to what's possible in terms of investing in the future after your business. There should be a future. It will come, whether it's for you or for your kids. Let's have
Right.
an exit plan that includes some income and not just a hope for the future. So go grab all the links in the show notes down below. Make sure you subscribe. We want to see you on tomorrow's episode of Harmonious at Lunch. And thanks for listening.